Germany has long been celebrated as the economic powerhouse of Europe. Made in Germany was a global benchmark for quality and reliability. The nation's economic health was a barometer for the entire Eurozone. This leadership role is now facing significant challenges. The once smoothly running engine is showing clear signs of sputtering. Understanding this shift is crucial for comprehending Europe's broader economic trajectory. The current state of the German economy presents a sobering picture, far removed from its traditional image of strength. Recent gross domestic product figures have been disappointing. In 2023, the German economy contracted by 0.3% according to the Federal Statistical Office, des Staates. This made it the worst-performing major advanced economy. While a slight technical recession was narrowly avoided in early 2024, the underlying momentum remains weak. Forecasts for growth in 2024 and even into 2025 are modest at best, with many institutions predicting growth rates hovering just above zero. Expert opinions paint a similarly cautious, if not pessimistic, view. Leading economic institutes in Germany have repeatedly revised their growth forecasts downwards. The Bundesbank, Germany's central bank, has also expressed concerns about the structural weaknesses hampering recovery. The manufacturing sector, traditionally the backbone of the German economy, has been particularly hard hit. Industrial production figures have shown persistent weakness, especially in energy-intensive industries. New orders have been sluggish, reflecting both weak domestic demand and a challenging international environment. Business sentiment surveys, such as the IFO Business Climate Index, have remained subdued for an extended period. Addressing this situation requires a clear understanding of the root causes, which are both external and internal. Germany's economic model is heavily reliant on international trade. Its export-oriented industries have historically been a primary driver of growth and prosperity. However, the global trade environment has become increasingly challenging in recent years. Rising geopolitical tensions, protectionist tendencies, and disruptions to global supply chains have created significant headwinds. The trade disputes between major economic powers, such as the United States and China, have had a ripple effect impacting German exporters. Competition from China in particular poses a multifaceted challenge. For many years, China was primarily a market for German goods and a source of low-cost manufacturing inputs. Now China is increasingly a direct competitor in high-value-added sectors, including automotive and machinery. The nature of global value chains is also evolving. The COVID-19 pandemic and subsequent geopolitical events have highlighted the vulnerabilities of highly extended and concentrated supply lines. For Germany, this means re-evaluating its sourcing strategies and potentially bringing some production closer to home. The surge in energy prices, particularly following the full-scale Russian invasion of Ukraine in early 2022, delivered a significant shock to the German economy. Germany was heavily reliant on Russian natural gas for its industrial sector and for heating. The abrupt curtailment of these supplies forced a rapid and costly scramble for alternative energy sources. While the country managed to avoid widespread energy shortages, the price of gas and electricity soared to unprecedented levels. This had a direct and severe impact on energy-intensive industries, such as chemicals, metals, and paper manufacturing. These high energy costs have eroded the competitiveness of German businesses in the global market. Although energy prices have moderated somewhat from their extreme peaks in 2022, they remain significantly higher than pre-crisis levels. The long-term solution lies in accelerating the transition to renewable energy sources and improving energy efficiency. Section 5. Structural fault lines, internal impediments to growth. Beyond external shocks and energy costs, Germany grapples with several deep-seated structural problems that hinder its economic dynamism. One of the most frequently cited issues is excessive bureaucracy and cumbersome regulatory processes. Businesses often complain about the lengthy approval times for new projects. This red tape can stifle investment, slow down innovation, and make Germany less attractive as a business location. Another significant structural challenge is the aging population and the looming shortage of skilled labor. Germany's demographic profile shows a declining working-age population, which puts pressure on the labor market and the social security systems. Many industries are already struggling to find qualified workers. Investment in public infrastructure and digitalization has also lagged in recent years. While Germany has a reputation for quality infrastructure, parts of it are in need of modernization. A significant public and private investment push is needed to upgrade infrastructure and accelerate the digital transformation. Section 6. The consumer sentiment puzzle. Why spending hesitates. Consumer confidence plays a vital role in driving economic growth, as household consumption is a major component of GDP. In Germany, however, consumer sentiment has remained stubbornly weak for a prolonged period. Various indices measuring consumer confidence have consistently shown German consumers to be pessimistic about their personal financial situations and the overall economic outlook. High inflation, particularly for essential goods like food and energy, has eroded the purchasing power of households. Many consumers feel that their incomes are not keeping pace with the rising cost of living, leading them to save more and spend less. Concerns about the overall economic trajectory and job security also play a significant role. Reviving consumer confidence will require a sustained period of lower inflation, positive real wage growth, and a more stable economic outlook. Section 7. Flickers of optimism, potential catalysts for recovery. Despite the prevailing gloom, there are some emerging signs that could potentially herald the beginning of an economic turnaround for Germany. One of the most significant positive developments is the cooling of inflation. After reaching multi-decade highs, the rate of price increases has been steadily declining. Lower inflation is crucial because it eases the pressure on household budgets, potentially boosting real disposable incomes and consequently, consumer spending. Another area of potential strength lies within specific sectors of the German economy. While traditional manufacturing has struggled, certain high-tech industries and service sectors continue to show resilience and growth potential. Germany remains a leader in areas like specialized machinery, automotive innovation, and green technologies. The global demand for solutions related to climate change and digitalization presents significant opportunities for German companies. Furthermore, the labor market, while facing skills shortages, has remained relatively robust throughout the recent economic downturn. Stable employment provides a foundation for consumer confidence and spending. If real wages begin to rise as inflation subsides, this could further strengthen the labor market's positive contribution to the economy. Section 8. The February 2025 election awaiting policy shifts. The upcoming federal election, anticipated for February 2025, holds significant potential to influence Germany's economic trajectory. Elections often serve as a catalyst for policy debates and can lead to new governmental priorities and approaches. The current coalition government has faced criticism for its handling of the economy and for internal disagreements on key policy issues. A new government, or a reconfigured coalition, might bring a fresh perspective and a renewed impetus for tackling the structural challenges that have been holding back growth. Different political parties have varying economic philosophies and proposed solutions. Some may advocate for increased public investment in infrastructure, digitalization, and the green transition. Others might prioritize fiscal consolidation, tax cuts for businesses, and deregulation to stimulate private sector activity. The outcome of the election and the composition of the subsequent government will determine which policy direction Germany takes. Section 9. Forecasting the future. When will the engine reignite? Projecting the precise timing of Germany's economic rebound is a complex task, fraught with uncertainties. Most economic institutions offer a cautious outlook for the immediate future. For instance, the German government's own projections, as of early 2025, anticipate very modest growth for the current year. Organizations like the IMF and OECD also forecast subdued growth, generally below 1% for 2025, with a slightly more optimistic outlook for 2026. An optimistic scenario for a German rebound might see a more noticeable pickup in economic activity starting in the latter half of 2025 or early 2026. This would depend on several factors aligning favorably. These include a sustained decline in inflation leading to robust real wage growth and a significant boost in consumer spending. It would also require a more stable global geopolitical environment, a recovery in global trade, and a tangible easing of energy prices. However, a more cautious and perhaps realistic scenario suggests a longer and more arduous path to recovery. If structural impediments are not addressed decisively, Germany could face a prolonged period of low growth. The upcoming election provides an opportunity for a policy reset.